Welcome back to Go Gaddis Real Estate Radio right here on AM 920 The Answer. In this segment, we're talking housing myths. We're talking busting those housing myths. We're talking about budgets if you're going to get a mortgage. We're talking about all kinds of stuff, but we're going to make it really, really simple for everybody so they'll understand it. You're listening to Go Gaddis Real Estate Radio. My name is Cleve Gaddis. I've been on the radio here in Atlanta for 13 years, been in real estate for 25 years. I own a company called Modern Traditions Realty Group with my business partner, Christy Valley. And the purpose of this show, the reason I am here today and every single Saturday, is to make real estate clear, to make real estate simple, easy to understand, and to make real estate transactions worry-free. If you want to ask questions that we answer on air or off air, if you want to make comments or push back or challenge things we say, or you want us to do some research on your neighborhood, it is so simple. Go to gogaddisradio.com. That's GOGADDIS radio.com. You can also subscribe to our podcast, sign up for our YouTube channel. You can do everything. But without further ado, I want to introduce my friend and an expert mortgage advisor, Matt Scout, who's with Southeast Mortgage. It is so good to see you, man.
Yeah, thanks, Cleve. I appreciate you having me.
Yeah, you're Vice President, Executive Mortgage Loan Originator. That makes you sound very, very fancy. I love that.
I'm glad to hear it.
When it comes to people understanding how it works to get a mortgage, I would say that in most cases, it's about as clear as mud. Would you agree with that? In most cases, there's no disrespect to the people who are getting a mortgage. It's they do plumbing, or they work in an office, or they're a doctor, or they're a lawyer. They're not doing mortgage loans all day, every day, and so they just don't understand. So let's just kind of have a mortgage discussion. Now, if you don't mind, I'd love to start with, over the last month, we saw some decreases. The Federal Reserve decreased the Fed funds rate. All of the decreases in mortgage rates had already happened before that happened, because I think the market, and you might have even said this to me, that the market sort of baked it in. The market kind of knew what was going to happen and kind of anticipated as what's going to happen. But my question for you is simple, and I would say in the last 2 months, rates have gone down 0.5 point. Would you agree with that number? Is that about?
I would agree. Yeah. It seems like everything has been baked into the Fed actually making a few announcements so that the market acted accordingly ahead of time, to knowing that things were going to be coming up.
Yep. And so have you done any analysis to determine if someone is at a, let's just say 6.25% rate instead of a 6.75% rate, how much more house they can afford as a result of that interest rate decrease?
That's going to be dependent on the price that they're looking at. So you will see that if you're going from, let's say, a 6% to 6.5% range, you're going to see a pretty significant change, but it's going to be dependent on that borrower and what their price point really is.
Love that. Well, maybe during the break, you and I can pull out our calculators and do a little math just to say if every buyer in Metro Atlanta had a 0.5% rate decrease, how much more spending power would that give them? I'm not saying, by the way, they need to use that, because in most cases they should buy whatever fits their bill and just accept the lower monthly payment and move on down the road. But I think it would be such an interesting thing to do. My guess is in today's market, somebody might have $25,000 or $30,000 more in buying power with interest rates going down that much. Don't quote me. I'm just actually making numbers up. But I think that's a pretty cool thing. Any other thoughts on interest rates and maybe what you're expecting to see over the upcoming 6 months or so?
Yeah, so from what we're seeing, at least the charts are currently showing that we're going to have 2 more rate cuts by the end of the year, and we're expecting to have 3 next year. So whether that be 25 basis points to 50 basis point cuts, we're not sure yet, but it does look like the rate cuts are going to be coming up here soon and baked into the market.
Yep. Now, I know you're not an economist, but you follow lots of them. You're always sharing information with me, which I really, really appreciate. And so why is the Federal Reserve deciding that they need to decrease the Fed funds rate, in your opinion?
In my opinion, I think it's a little bit of a balance of they're seeing things cool off a little bit economically. Jobs reports are getting a little bit better. Inflation isn't jumping up as much as they thought so far, even though there are some concerns long term there. So they were able to slow things down a little bit, cut the rates to see where things go. And if we still see the cooling in general economically, that's probably where we're going to see more Fed cuts.
And so is the Federal Reserve, is their mandate to keep inflation about 2%?
That's the goal. Yes.
And then do you know what it was when they released their reports recently? I didn't see what it was. I think it's still over 2%, but
Yeah, I think there's either 2.3 or 2.7. I can't remember offhand the exact number, but yeah, it was higher.
and what is their mandate when it comes to employment? Because they're trying to hit a certain employment goal, and when they miss it, and when inflation's under control, they miss it, they're going to ease rates in many cases. And I think that's a
Correct.
lot of what drove the recent change. Do you know what the benchmark is there, what the goal is?
Benchmark, I can't remember offhand, but we're going to see a lot of change right now just because of a lot of political factors right now with a lot of people leaving the country.
Yep.
You're going to see a lot of jobs start to become available. And so you're going to see a lot of change on that part. So I'm curious to see in the next few months exactly what that's going to bring.
Well, I never thought about that, but it could get a little bit worse before it gets better because we are making a lot of changes. I heard they're making changes on the whatever it's called, the A1B visa, what H1B visa,
Yes.
and a lot of people might not even be able to stay in the U.S. So when I was in my early 20s, 23 years old, I bought my first house. I was so excited. It was $132,500 in Columbia, South Carolina. I thought it was a mansion. It was a brand new home. I paid 10%
Wow.
down. I have no idea how in the world I was able to save $13,000 for a down payment, but I was told that I would not be able to qualify for a home if my payments exceeded 28% of the loan amount. No, if my payments exceeded 28% of my income. Excuse me, I got to get this right. Is that right? Is that what are the, if somebody wanted to know, okay, how can I determine whether or not I qualify to buy a home? How would they do that today?
Yeah. So you're talking about debt to income ratio.
Right. Thank you.
And yeah. So to a certain amount, yes, 28% does play a role, but it is more or less not what we're going off of.
Okay.
But we have to also talk about the debt to income is different for each loan type.
Okay.
So if we're looking at 28%, the reason why people bring that up is because that is like a standard for a conventional loan if you're doing like manual underwriting, but it is not actually the benchmark that we go off of.
And is that 28% of my gross income? Is it 28% of my after-tax income?
It's going to be the gross income.
28% of your gross, which, so really what they're doing is they're giving you almost a meaningless number because you never get all of the gross in the first place. So that is an interesting thing. So you said debt to income ratio. Let's just say it's an FHA loan. How high can the debt to income ratio be and still be approved for an FHA loan?
So there's two ratios that we have to go off of. First one is your front end ratio. That's going to be your actual mortgage payment divided by your gross income. So that you want to stay at 46.99% or below.
Okay, so not 28.
Not 28, no, not even close.
Okay.
Your second ratio is actually going to be your mortgage payment plus any debt on your credit report divided by your gross income, and that can go up to potentially 56.99% or below. So those are the actual benchmarks that we're looking at. Now, each person is going to vary depending on credit score, depending on amount of reserves of money in the bank, but those typically will be your limitations.
So let's just say that I made $100,000 a year, and
Yep.
so that would be 83, 33, 33 a month. And you're saying that I could have up to, what'd you say, 56% total debt?
56.99.
56.99. So that means I could have total debt payment obligations of $4,700 a month and still be approved for my loan.
That's correct.
Wow. I'm not sure I should be approved for a loan if that was my numbers, but because I might be a little bit house poor. But so if somebody had, $500 a month in student loans and they had $800 a month in car payments, then they could afford the difference of whatever that would be, $3,800 or whatever in terms of house payments. So a lot of times, as long as people understand exactly what their monthly debt obligations are, they could figure out whether or not
Yes.
they could qualify for something, couldn't they?
Correct. And that's usually the thing. We go down the rabbit hole of really talking about not pushing the limitations, but finding out, okay, what is your monthly budget? What are you comfortable with? So that we are not pushing things to the limit and setting up a borrower for failure.
What is so interesting, if you asked me today, what's your monthly budget for housing, Cleve, I'd say $2,000. And if you'd asked me the same question in 1993, I'd have said $2,000. Meaning that's just where I'm comfortable being, which you can actually make it work because you get a lot of equity in your home, and that's the way it is. I think I could maybe qualify for a little bit more than that, but that's where I'm comfortable. I like my payment to be around $2,000.
That's perfect.
It'd be kind of hard in today's world to do that, wouldn't it?
Hey, depends on how much money you have.
That's true. Hey, we got about a minute and a half left in this segment, and my question for you is, if there were to be one area that trips up borrowers as often as possible, meaning it's like, oopsie, this is messed up, I've messed up, what would that be?
I would say the biggest thing is going to be missing payments or opening up new credit items on their credit during the process.
Because you pull credit up front, but then you have to pull it right before closing as well. And so if they have new credit lines, is it sort of assumed that, okay, they probably owe more money, so we can't do this?
Correct. And that also plays into the debt to income factors of all of a sudden you have a new payment. What if you were right up at that limit of 56.99, then you add in a new credit card or auto loan, we might have a big problem.
Yeah. So opening new lines of credit. And then what was the other one you said?
Making sure you're making payments on time.
Now, I'm going to be honest with you, and this is going to sound very judgmental, but I don't see how that could be a surprise to someone. I guess maybe, you know what, I guess they could just mistakenly miss a payment in the middle of that and then wind up having a problem.
We have a lot of people that they start the process and they kind of just check out. It happens a lot more than you think. So we have to say a lot of stuff up front, but all of a sudden we'll get a notification that they missed a payment past 30 days, 60 days, what have you, and that could be a big problem.
Yeah, I totally get it. We're going to take a quick break. You'll stick with us for the next segment. I hope when we come back, we're going to talk about lower interest rates again, maybe a brighter outlook for the future, and all kinds of things mortgage related. So stick with us. We'll be back.